The recent report highlights the pressing need for a strategic transition in the U.S. primary metals manufacturing sector amid ongoing global trade tensions. With aluminum demand in the U.S. rising by 3.6% in 2024, reaching 4.3 million metric tons, the domestic production lags significantly, fulfilling only 670,000 metric tons. This disparity underscores the U.S.'s heavy reliance on imports, particularly from Canada, and emphasizes the importance of strengthening domestic supply chains. Secondary aluminum production has shown resilience with a 5% growth, indicating potential for innovation within the industry. The report suggests that strategic investments are crucial to enhance the sector's competitiveness and reduce dependency on foreign imports, especially as it pertains to key industries like construction, automotive, and energy. The U.S. government's policy measures, such as the Bipartisan Infrastructure Investment and Jobs Act and the Build America, Buy America Act, have been pivotal in revitalizing the metals manufacturing industry. These initiatives, along with strategic tariffs reimposed in March 2025, aim to boost domestic production by countering global excess supply. However, while these tariffs benefit domestic producers, they simultaneously increase costs for downstream industries reliant on steel and aluminum, potentially affecting their competitiveness. The report also notes China's dominance in global metal production, with its subsidized electricity rates and aggressive government programs making it challenging for U.S. manufacturers to compete. Despite these hurdles, the industry is witnessing a positive trend in capital investments, with $4.7 billion announced for 42 projects in 2024, signaling optimism for future growth and modernization efforts.
The ongoing trade conflict between the United States and China, initiated during the Trump administration, has inadvertently positioned Vietnam as a significant beneficiary. As U.S. tariffs on Chinese goods intensified, many international manufacturers began shifting their production bases from China to Vietnam, seeking cost efficiencies and maintaining product quality. This migration has bolstered Vietnam's status as a manufacturing hub, attracting global companies eager to mitigate the impact of the trade war while benefiting from Vietnam's lower labor costs and increasing production capabilities. The economic ramifications of the U.S. China trade war have been profound for both nations. The U.S. imposed tariffs on approximately $350 billion worth of Chinese goods, while China retaliated with tariffs affecting $100 billion of American exports, notably impacting U.S. farmers. The broader economic impact included job losses and a reduction in GDP growth for the U.S., with estimates suggesting a $316 billion cost to the American economy by the end of 2020. Conversely, Vietnam's strategic positioning and economic policies have enabled it to capitalize on the trade diversion, enhancing its economic growth and solidifying its role in global supply chains. This shift underscores the dynamic nature of global trade and the unintended consequences of protectionist policies.
Airbnb has unveiled a redesigned app as part of its strategic expansion into offering services beyond traditional home rentals. This development is a significant move for the company, which plans to invest between $200 million and $250 million into this new business segment. The revamped app will enable travelers to book additional services, such as catering and personal training, directly at their rental accommodations, aligning Airbnb's offerings more closely with those typically found at hotels and resorts. This initiative marks a shift in Airbnb's business model, which had previously focused primarily on home rentals, especially after scaling back diversification efforts during the COVID-19 pandemic due to global travel disruptions. The new app features a dedicated services tab, offering 10 categories of bookable services, and will be available in 260 cities worldwide. In addition, Airbnb is enhancing its experiences business, originally launched in 2016, by expanding the Experiences tab to include 19 categories across 650 cities. This includes unique offerings, such as architecture tours and live performances. The company is also preparing to provide services and experiences for the 2026 Winter Olympics in Milan. Despite these ambitious plans, Airbnb's stock recently faced pressure following a disappointing revenue forecast, attributed to a slowdown in travel from Canada to the U.S. amid broader economic uncertainties. The company's efforts to diversify its revenue streams could be crucial in counteracting these challenges and driving future growth.
Achieve Life Sciences has announced its financial results for the first quarter of 2025, reporting a net loss of $12.8 million and holding cash and marketable securities totaling $23.2 million as of March 31st. The company is advancing its cytisinicline program, a novel treatment for nicotine dependence, with plans to submit a new drug application, NDA, to the U.S. Food and Drug Administration, FDA, in June 2025. This submission could introduce the first new FDA-approved treatment for smoking cessation in nearly 2 decades, potentially transforming treatment options for patients and healthcare providers. The company's progress is highlighted by the successful completion of 2 Phase 3 trials and the long-term exposure study, all meeting key FDA safety requirements. The Phase 3 ORCA-3 trial, involving 792 U.S. adult smokers, showed significant efficacy in reducing nicotine cravings and increasing quit rates, with results published in JAMA Internal Medicine. Additionally, the ORCA-OL long-term exposure trial reported no significant safety concerns after 6 months and 1 year of treatment for over 300 and 100 participants, respectively. Achieve's strategic focus on cytisinicline is reinforced by a recent Science Advisory Board meeting with leading experts, underscoring the drug's potential to shift treatment paradigms and improve public health outcomes. As Achieve prepares for its NDA submission, it aims to address a significant unmet need in the smoking cessation market, which could have substantial implications for public health and the company's market position.
Indian stock markets experienced their largest single-day decline in a month, primarily driven by profit booking and concerns over foreign capital outflows towards China following a trade détente with the United States. The Nifty 50 index fell by 1.39% to 24,578.35, while the BSE Sensex dropped 1.55% to 81,148.22. This downturn comes after a strong rally in the previous session, where both indices had gained nearly 4% due to a ceasefire agreement between India and Pakistan. Despite the overall market decline, small-cap and mid-cap stocks managed to close higher, buoyed by gains in defense-related companies and a rally in key constituents following their earnings reports. The recent U.S. China trade agreement, which involves a temporary reduction in tariffs, is seen as a potential catalyst for foreign institutional investors to redirect their capital towards China, impacting the Indian market's attractiveness. Notably, IT stocks, which had surged 6.7% in the previous session, fell by 2.4%. Financial heavyweights like HDFC Bank and Kotak Mahindra Bank also faced declines. In contrast, pharmaceutical stocks rose by 1.2% as concerns over U.S. drug pricing regulations eased. Market participants are now awaiting India's April inflation data, with expectations of a significant easing due to moderating food prices. This data could provide further direction for the market, which currently lacks immediate positive earnings triggers.
Gold prices in New Delhi surged by Rs 950 to Rs 97,500 per 10 grams, driven by firm global cues, according to the All India Sarafa Association. This uptick comes after a sharp decline on Monday, where prices for gold of 99.9% and 99.5% purity fell by $3,400 each. The recent rally is attributed to a pause in the U.S. China trade conflict, which saw the U.S. reduce tariffs on Chinese imports from 145% to 30%, and China cut duties on U.S. goods from 125% to 10%. This easing of trade tensions has calmed global markets, leading to a rebound in equities and a subsequent pullback in gold prices. Globally, spot gold rose to USD $3,253.38 per ounce, recovering from a significant dip on Monday. The renewed safe haven demand is partly due to geopolitical tensions, notably Israeli airstrikes on Houthi rebel positions in Yemen. Additionally, market participants are closely watching the upcoming U.S. Consumer Price Index (CPI) data release, which could impact the Federal Reserve's interest rate decisions and thus influence gold's price trajectory. The interplay between easing trade tensions and geopolitical risks continues to shape the precious metals market dynamics.
Shares of 197 Communications, the parent company of Paytm, experienced a decline of over 1% on May 13th, following reports that Ant Group plans to sell up to 4% of its stake in the fintech firm. The stock closed at Rs 856.55 on the BSE, reflecting a 1.13% drop, and similarly decreased by 1.16% on the NSE. Intraday trading saw the stock plummet by nearly 5% before recovering slightly. Ant Group, associated with Alibaba Group, intends to execute this sale through bulk deals on both the BSE and NSE, potentially offloading 25.5 million shares, valued at approximately 2,066 crore. This stake reduction by Ant Group, which held a 9.85% stake in Paytm as of the end of the March quarter, could influence market sentiment and shareholder confidence. The involvement of major investment banks like Goldman Sachs and Citigroup as placement agents suggests a strategic approach to the sale, aiming to minimize market disruption. The move comes amidst a broader context of regulatory scrutiny and market volatility affecting Chinese tech investments globally, potentially impacting Paytm's stock performance and investor perceptions in the near term.
Manappuram Finance Limited reported a standalone net profit of 414.3 crores for Q4 FY25, marking a 3.3% decline compared to the 428.3 crores recorded in the same quarter of the previous fiscal year. Despite this quarterly dip, the company achieved a robust annual profit after tax (PAT) of 1,783.3 crores for FY25, up from 1,657.8 crores in FY24. The consolidated income from operations also saw a significant increase, rising 13.5% to 10,041 crores for the year. However, Q4 FY25 income from operations slightly decreased by 0.50% year-on-year to 2,360 crores. The company's consolidated assets under management, AUM, increased by 2.3% year-on-year to 43,033.75 crores, driven by growth in gold loans, which have been a key focus area. Notably, the non-gold loan business now constitutes 40.5% of the total AUM. Conversely, Asirvad Microfinance, a subsidiary, experienced a substantial decline in AUM, decreasing by 18.2% sequentially and 31.1% year-on-year. CEO VP Nandakumar emphasized the company's strategic recalibration and resilience in maintaining growth in gold loans and secured MSME lending, despite challenges in the microfinance sector and ongoing regulatory issues. This strategic focus is aimed at sustaining a strong financial position and diversifying the company's product offerings.
Intuitive Machines Inc., a prominent player in the space technology sector, has released its financial results for the first quarter of 2025, showcasing strategic growth and diversification efforts. The company, led by CEO Steve Altimus, is capitalizing on the evolving federal landscape, particularly the shifting priorities of NASA, to expand its operations beyond lunar missions into areas like national security space. This strategic pivot is intended to leverage Intuitive Machines' established capabilities in space technology to tap into broader markets, thereby enhancing its role as a comprehensive infrastructure and data services provider within the space economy. The financial report includes key metrics such as Adjusted EBITDA, which the company uses to assess operational performance by excluding non-operating income and expenses. This measure, while not compliant with GAAP, offers insights into the company's core business trends and is widely utilized by industry analysts, Additionally, Intuitive Machines highlights its contracted backlog as a forward-looking indicator of potential revenue, reflecting the company's strong pipeline of future work. These financial indicators, along with the recent successful lunar missions, underscore Intuitive Machines' priorities: robust positioning for sustained growth and innovation in the competitive space technology landscape.
Bicara Therapeutics Inc., a clinical-stage biopharmaceutical company, has reported its financial results for the first quarter of 2025, highlighting a robust financial position with approximately $462 million in cash and cash equivalents, projected to sustain operations until the first half of 2029. The company is advancing its lead program, Ficerafusp alpha, a bifunctional antibody targeting both epidermal growth factor receptor, EGFR, and transforming growth factor beta, TGF-beta, aimed at treating solid tumors. The ongoing pivotal Phase 2-3 trial, FORTIFY-HN01, focuses on HPV-negative recurrent metastatic head and neck squamous cell carcinoma, HNSCC, an area with significant unmet medical needs. Bicara is set to present updated data from its ongoing Phase 1-1b trial at the 2025 ASCO annual meeting, which could demonstrate the potential of Ficerafusp alpha in providing a differentiated and durable response in cancer treatment. The company has also showcased several datasets at the American Association for Cancer Research, AACR, underscoring the broad therapeutic potential of Ficerafusp alpha. These developments are crucial as they may influence market sentiment and investor confidence. Given the promising outlook of the drug's efficacy in combating resistance mechanisms and prolonging treatment durability, Bicara continues to focus on its strategic clinical developments while ensuring financial stability, positioning itself as a key player in the biopharmaceutical landscape.